Dr. Sanjib Pattnaik uh, will be dealing in today's session regarding a particular course which is titled as Equity Markets. Now, this course has been coded as MMPF 007. Already in the previous sessions, if you go back to the various other sessions on this particular course, then we have covered block 1, which comprised of the basics of equity markets. Then we have entered into block 2, where we have gone through unit 3, unit 4, and today in this particular session we will be discussing about unit 5, which will be telling us the regulatory framework that the equity market is subject to. So our focus will certainly be in the Indian equity markets or in the Indian economy. Now, when we are talking of regulations, we shall try to answer why regulations are required, how regulations are done for various categories of the equity markets. So, when we had, particularly in the Indian economy, the LPG, liberalization, privatization, and globalization during the 1990s, prior to the LPG reforms or prior to 1990, all the capital issues were regulated by CCI, Controller of Capital Issues. When we are talking of capital issues, we are talking of the equities, the preference shares, the debt instruments, etc. So all the long-term funds that an organization requires in order to build up its capital structure. Now this Controller of Capital Issues CCI was established in 1947 under the CCI Act. Now, what was the basic function of this CCI? Now, its basic function focused on approving any public issue by a company in the Indian economy. Without its approval, nobody could go for public issues. However, the Controller of Capital Issues or the CCI recommended a fair price of equity. When we say fair price, it is not the same as the market price or the price which is determined according to the demand and supply forces in the market. Now, the fair price was fixed by CCI, which did not have the total conditional impact of demand and supply position in the marketplace. Now, this fair price of equity which CCI was recommending, this led to underpricing because the market prices may be somewhat higher. So when it was the market price is higher and the fair price is lower, then we say the issues were underpriced. And this led to oversubscription of IPOs. And the IPOs, they were not able to cater to the requirement of the various potential investors. So instead of doing that, the firms went for debt financing. That means loan funds, where the amount of interest and principal was known to the organization. Instead of having a forced devalued equity share capitalization from the market, the firms were assured of the interest and the principal repayments through debt financing. However, all this kind of dilemma led to the CCI was abolished and SEBI, Securities and Exchange Board of India, assumed the role of CCI. So this came after the reforms of 1990. Now, furthermore, CCI was not there in the Indian economy, and it is starting from those 1990s till date. SEBI is the regulatory authority of the capital issues. So it always is trying to monitor closely, to take into account the requirement of the investors, to check the fraudulent practices by the organizations, so that the economical flow of funds from the potential investors to the organization requiring them is fair enough. There is nothing called as hidden thing that a company can do. Now let us see what are the regulations as it has been prescribed by SEBI. We have seen in our earlier sessions that for an equity share or the public issue of equities, we go for different stages: pre-issuance and issuance. That means before the issue starts, what are the activities that should be done so that a company or organization can go for the issue of equities. First of all, the organization through its merchant banker prepares the offer document, which is submitted to SEBI. Now this offer document is an information booklet or information, you can say handout or information catalog, which tells about the company, its promoters, its line of business, its future plans, its financial performance over the last uh, various periods, as well as how much is the debt capital in the capital structure. All such informations are incorporated into the offer document so that any potential investor can have a fair, free, and transparent judgment regarding the equity issue. For IPOs or initial public offerings, the offer document is called as prospectus. Now, this prospectus will be telling, as just now we discussed, the company, its operations, its promoters, its financial track records, its future plans, its audited statements, etc. When the prospectus is prepared, it has to be submitted to SEBI for any kind of necessary changes or recommendations. Similarly, for rights issue, when we say rights issue, what happens? Suppose an organization is going for issuing fresh equities or new equities in the open market. Now, before it is open to the public, first it is offered to the existing shareholders as a matter of right, since they are the owners of the company from the beginning. So, for rights issue, we call this offer document as letter of offer, and it is given to every existing shareholder of the organization. Now, these two documents, whether you are going for IPOs or for rights issue, that means prospectus or letter of offer, respectively, it has to be submitted to SEBI. The SEBI personnel, they go into the details. If anything is found to be missing, anything which has to be deleted, or any kind of corrections are to be made, it is suggested again by SEBI to the merchant banker of the organization. Now, this feedback from SEBI is incorporated into the offer document, be it prospectus, be it letter of offer. The standard time taken by SEBI to process this either prospectus or letter of offer is 30 days. Now, this draft offer document is made available on SEBI website. Why does SEBI shows the offer document or the draft offer document on its website? So that suggestions can come from various avenues like the potential investors, like the government, like the researchers, etc. Any kind of suggestions that is there, people can look from the SEBI website regarding the company going for IPOs or rights issue, and it will be made available on the SEBI website. Now, after providing this offer document or the draft offer document to SEBI, the company or the issuer, so through its merchant banker, should advertise in newspapers regarding the location of its head office. Now, what kind of newspaper? One newspaper can be a leading English newspaper which has its presence all over the country. That means India. Another advertisement has to go to a newspaper in Hindi language which also has a national presence. The third advertisement should be done in the regional language newspaper in the particular state where the organization is having its head office. Now, once these are done and SEBI is satisfied that yes, whatever suggestions are done have been incorporated into the draft offer document, then SEBI approves the document. However, before the approval of recognized stock exchange where the particular issue is going to be listed has to be there. for follow-up public offers and rights issue, it can only be done through stock exchanges having nationwide trading terminals. So, suppose one would ask, why nationwide trading terminals? Now, since we are going for a public issue, be it in the form of follow public offer or rights issue, that means shareholders spread across the geographical region of India, anyone can transact through the portal of the stock exchange, that means nationwide trading terminals. Now, in the regulation for pre-issuance, what is the job of the merchant banker? Now, when a company decides to raise funds from the equity capital or raise capital in general, it appoints a particular specialized financial institute that is called as merchant banker, who looks after the whole process of undertaking the shares transactions or the issue activities. So for that, there should be agreement between the issuer of the equity capital and the merchant banker. So now it becomes the responsibility of the merchant banker that every activity for the issue has to be submitted to SEBI. So merchant banker has to submit to SEBI the agreement between issuer and the merchant banker, and it takes up the responsibility of looking after the success of the issue. Now, what does merchant banker submits to SEBI? One can be, the most important can be, whatever suggestion has been made by SEBI, the merchant banker should see that it has been incorporated in the draft of a document. So after the suggestions have been offered or incorporated into the offer document, it will be submitted again to the SEBI by the merchant banker. The merchant banker should also provide a due diligence certificate. What is a due diligence certificate? The merchant banker should certify itself, that means it will provide an undertaking that whatever are the things that has been described in the prospectus which has been approved by SEBI is taken care of. All the activities that are involved in success of an issue, those have been carried out in a free and transparent way. So all these kind of things should be put up by merchant banker in to the SEBI. It should also try to submit to SEBI, or it has to submit to SEBI a resolution by board of directors for allocation to promoters before issue opening. Now, who are the board of directors? Now, they are the representatives of the general shareholders or the equity shareholders. Equity shareholders, through their voting rights, they select the board of directors. So the board of directors manage and run the company. They should provide a resolution regarding the allocation of the shares to promoters before issue opening. Then a chartered accountant certificate regarding promoters should be submitted to SEBI by the merchant banker. Now, what the chartered accountant provides regarding promoters, their net worth should be how much, whether it has been complied to, whether the profit over the last few years is as per the guidelines to go for an issue. All these things will be certified by the chartered accountant. Sometimes we have fast track issues. We know that the issue process or the issue of equity share is a very lengthy process. It consumes more time as compared to another route of raising capital called as the fast track issues. That means we try to go for the issue as soon as possible, provided the following conditions would have been met. First is listing for at least 3 years. That means an existing company which is trying to tap the market through a fresh issue of equity shares, that means IPOs, has to be listed in a recognized stock exchange for the at least last 3 years. So a continuous listing has to be there for 3 years for the particular organization. Second compliance is the market capitalization of public holding is at least 10,000 crore rupees. Now, for the organization going for fast track issues, there should be assured that the public, whatever the number of equity shares they are holding, their market capitalization should be at least 10,000 crore rupees. Now, what is market capitalization? Suppose any item that we have, we take it and sell it in the market the next instant. So it will fetch us a price. So that is the market value of the particular thing. So when we are talking of market capitalization, what we mean? If we take the equity shares in hand or in the hands of existing public, if all are sold off in the market today, how much value it will generate? Now we say, if it is more than 10,000, you can go for fast track issues. Less than rupees 10,000 crore rupees, then we say it is not allowed by the regulation to go for fast track issues. So market capitalization of public holding is at least 10,000 crore rupees. Another vital factor here is, if a company wants to go for fast track issues, then the company should have, or the organization or firm should have addressed at least 95% of complaints. So whatever are the complaints from the existing shareholders coming up, the company should have provided a solution or given certain data information to the complainant so that their complaints are addressed to. So this should not be less than 95%. That means whatever are the complaints, at least 95% should be or should have been addressed. Another regulation for going for fast track issues is that the organization should have compliance with listing agreement for at least last 3 years. So whatever is the listing agreement is there, those should be there for at least 3 years so that we can comply and go for fast track issues. Another important point is there should be no show cause notices against the promoters, against the management, etc. So all the, we can say, activities are done in such a way that it is within the parameters of legality, and we do not have to ask for the show cause. So the promoters should not have any kind of show cause notices as until the date of issue. Now, audited accounts. When we try to go for the fast track issues, we see that our accounts are audited for at least 3 years. Audited or audits are made by chartered accountants who certify that our financial transactions are all according to the rules and regulations. So that certificate has to be given by the audited accounts or the banks. Then another fast track issue requirement is shareholding of promoters in demat form. Now what is that demat form? Demat stands for dematerialization. Suppose in front of us we have any kind of material things that you can look at. You can see them, you can touch them, you can feel them, you can take them from one place to another. Suppose in order to go for fast track issues, the promoters' equity shares are there in the demat form, then it is possible to go for the fast track issue. So shareholding of promoters in demat form should be there. Now we shall move on to the regulation. While the process of issuing the shares go on, and after the issue is closed, what are the post-issue activities? So during issuance, already we have got approval from SEBI to go for the raising of funds through equity, etc. So during the process, the first step is dispatch of issue material by the merchant banker. So whatever are the issue or issuance related material, they should be dispatched. Minimum subscription. So you have to provide data regarding the minimum subscription. Usually what happens, we try to see that in order that a particular IPO is successful, a minimum of 90% of the shares should be applied for. That is called as the minimum subscription. Oversubscription also is there. What is oversubscription? Suppose people's sentiments are there that the company is an existing one and it has a very good track record regarding the financial aspects. So there the potential investor may be attracted towards the particular issue, and this sentiment can spread like wildfire. So what happens? The demand increases very much. So the case will be over subscription. Now, a monitoring agency should also be there to look after the financial transaction of the particular organization. Now, when we are talking of monitoring agency, if the issue size is more than rupees 500 crores, then a public financial institution has to look after the things. When we say public financial institution, we are meaning that the organization's activities should be looked after, taken care by this particular public financial institution. It is done only when the amount to be raised is more than rupees 500 crores. Now, payment of subscription amount in calls. Here we are finding a new term called as the calls. Now, when a share is issued, IPO is issued, suppose the market value of the share is pinned at 90 rupees per share. However, if we look closely, the cost of that particular thing is rupees 500. Now the gap between 900 and 500, that is the 400 rupees, is the deviation of the gap between the issue price and the face value. Suppose a equity share has a face value of rupees 100. That means on the share certificate it will be mentioned the face value is limited to or is rupees 100. It means the liability of the company to that particular shareholder holding one equity share is maximum up to rupees 100. The company will not pay anything extra in times of liquidation, provided the thing has been gone through. Now, when we go for an issue, first is a potential investor, if they are interested in going for this particular equity shares through the IPO, they can pay according to different stages. What are the stages? Now the first is a portion of the total value of the equity share will come from the amount that is given by the potential investor or the general public. Suppose the 100 rupees, 20 rupees is required to be eligible for applying a particular equity share in the IPO. Now here what is happening? The company is getting out of 100 rupees capital requirement 20 rupees through application money. Now if the applicant gets the equity share, then well and all right, 20 rupees belongs to the company. If the other way round, that means the applicant, if it does not get a equity share allotted in their name, then it will get back its application money. Now after the application comes the allotment part. That means those applicants who are selected, or up to what extent they are selected, they have to pay the remaining amount of the equity shares. Now, already 20 rupees has come from application money. Out of 80 rupees, suppose we say the company has decided to pick up 40 rupees as allotment money. That means when the equity shares are given to the equity share whose application has been approved or it is successful, then the particular equity shareholder is asked for 40 rupees now as allotment money. So out of 100 rupees, now we have got 40 plus 20 is the application, 60 rupees. Still 40 rupees are to be collected from the shareholder for this particular equity share. So here the company can go for calls. What is call? Now the company will ask the investors, that means those who are holding the equity shares, that you pay me the remaining 40 rupees within this stipulated time. So it can be in a particular call or it can be multiple calls also. So there is a case of multiple call and we have two calls. One call is for 10 rupees, last call is for 30 rupees. So here we know that if we get all the call money, that means application 20, allotment 40, then first call is again 10 rupees and the final call is 30 rupees. So what do we understand? The total amount of rupees 100 has been collected from the investor by the issuer. So now this amount has to be collected within a given stipulated time. So the payment of subscription amount in calls can be done. Then allotment, refund and payment of interest. Now we put our application or we subscribe for the equity shares. If we have the chance or equity shares are allotted to me, that means I have been successful in getting the equity shares, then I have to pay the allotment money. If I do not pay the allotment money, then what will happen? The issuer has to return back the subscription money to the investor. Now, this is the process of refund, and the time period, that means the time from payment of subscription amount till it is refunded, if the case is so, the issuer has to pay interest to the potential investor. Alteration of right of holders of securities cannot be done easily. Suppose at the time of issue, through the prospectus, we have said that these are the right of the holder of securities. Now, once the issue goes into the market, the investors have been chosen and are allotted equity shares. There, the issuer cannot say that your rights have changed as compared to the offer document. So, whatever is there in the offer document, the issuer has to adhere by that. The period of subscription. Is there any regulation regarding period of subscription? The answer is yes. It is usually 15 days. Then the company or the issuer goes for advertisement of public issue. Now, this advertisement can be through newspapers, and newspapers have to be at least one national newspaper in English, one Hindi newspaper nationwide, third, any regional language newspaper. So, the IPO or the issuer of IPO has to advertise through its merchant banker. Similarly, nowadays the advertisement is also done through electronic media. Then we have a regulation for minimum application value. Now, in order that a IPO is successful, the application value should be forming at least 90% of the total issue value. Otherwise, the issue is considered as a failure. Now, whatever is the subscription money that we have got, how we have utilized it. It is the money of the issuer. So the merchant banker has the task of providing information regarding this subscription money. Now let us see the rights issue. What are the regulations for that? Now when we are talking of rights issue, what is a rights issue? Suppose there is a existing company. Already it has issued equity shares in the market previously, whereby suppose 60% of its authorized capital, that means the maximum level of capital the company can have. That means it has gone for 60% in the earlier days. So these equity shareholders of the already past days, they become apprehensive when a IPO comes to the market from the equity shareholder, from the issuer. Now, this IPO, before it is done, the offer has to be done to the existing shareholder first. They will have preference over the issued share. Usually, these are at a price which is below the market price. If the existing shareholder want, they can purchase the equity share that the company or the issuer is going for. Now, in this rights issue, what are the regulations? Record date. Now, when a issuer through its merchant banker goes for IPO, it has to take into account the existing shareholder. Now we know that existing shareholder, due to transactions in the stock exchange, that means the buying and selling of the equity shares, the shareholders may be changing, or the proportion or the holding percentage of the shareholder will also be changing. So, on what date, that we shall consider that this is the date on which we have considered the shareholders as the existing shareholders. That date will be called as the record date. That means at a particular point of time, these are the shareholders. Restrictions for rights issue. You cannot go for rights issue if there are convertible debt instruments, because the issuer has already committed to the debt instrument holders that it will be converted into equity shares. So, if there are convertible debt instruments, you have restrictions in the rights issue. You have to prepare a letter of offer which has to be sent to the existing shareholders, and also a copy of the letter of offer should be submitted to SEBI by the merchant banker. And as we discussed just now, what should be the price of the rights issue? The price of the rights issue are always or usually below the market price, so that existing shareholder try to purchase them and maintain their ownership or ownership proportion in the capital of the company. Now, for how many days you will be allowed to subscribe, that also has been prescribed by SEBI. And before issuing the rights issue, you have to go for pre-issue advertisement that the company is going for rights issue at this market price, at this particular price, and whatever are the funds that are generated from the rights issue will be collected by the merchant banker, and they will be transferred to the issuer, and the issuer shall be transparent or provide information on utilization of funds raised. Similar to rights issue, we also have regulations for bonus issue. Now, when we say bonus issue, what is it? Now, sometimes the company, out of its previous year's profit, it tries to hold back some proportion of the previous year profits as in the form of retained earnings. Now, when these retained earnings pile up, this belongs to the shareholders. So, this is distributed to the shareholders in the form of bonus issue. That means shareholders get the issue free of cost, or in other words, they get their share from the retained earnings. This has to be authorized by articles of association of the issuer. Now, one important regulation as regards to bonus issue is that there should be no default in interest and principal repayment. Now, the company's capital structure has equities as well as debts. Debts usually are paid interest on a regular basis or fixed time periods, and the principal repayment is usually done at the maturity. So the company should have no default in this too. That means interest and principal repayment. Another important point also for going for bonus issue, the regulation states that there should be no statutory dues of the employees remaining unpaid. Now, what are statutory dues? We have provident funds, we have the ESI payments, we have pension funds, etc., which are provided by the company or the issuer. Now, this kind of statutory dues, which have to be paid to the employees or paid on behalf of the employees, they should be not unpaid. They should be always paid up. Another regulation is all the shares or the existing shares should be fully paid up. Now, just 2 or 3 slides back, we are looking at what is the way in which the company or the issuer through its merchant banker collects the issue amount from the shareholders or the potential shareholders. We have application money, we have allotment money, we have call money. All this combined to give the total value of the equity share. That means the full value of the equity share. So, in order that an issuer goes for bonus issue, all shares should be fully paid up. Now, the bonus issue should be completed within 15 days from the approval of board of directors. That means board of directors should approve the bonus issue, and starting from that point of time, within 15 days, the whole bonus issue process should be completed. Now, convertible debts. What are the regulations that has been prescribed for it? Debt instruments are those where we have to make regular interest payment called as coupon payments, as well as sometimes we also have, or mostly we have, maturity or the redemption. That means the principal amount of the debt should be returned back. However, there are certain debt instruments which are convertible. Convertible means they will be changed into another form. What form? Another equity shares usually. Now, if it is the case of convertible debts, the regulation for that is, or the issuer going for a convertible debt, then through its merchant banker, it has to go through or comply through these regulations. One is obtained credit rating. Now, SEBI has made it mandatory that for debt issues, the raising of funds through debt, credit rating is a must. Lesser is the chance of default in interest and principal repayment, the better is our credit rating by various independent credit rating agencies as authorized by SEBI. So, you can have credit rating agencies like CRISIL, etc., who certify regarding your credit status, whether you will be able to repay the principal, whether or not you will be able to repay the uh, interest payments, etc. There should be one or more debenture trustees. These trustees look after the way in which the debt funds are utilized regarding the payments of interest and the principal are done. Now, for that, the issuer has to create a debenture redemption reserve. That means it has to keep aside a pool of funds or funds which will be able to satisfy the principal repayments as well as the regular interest payments on these debt instruments. Sometimes these convertible debts have a charge on the assets. Suppose a machinery is there, big machinery, and it is associated with the convertible debt. That means in case of default in paying the interest and principal by the organization, the whole amount of selling the machinery will be considered for repayment of this interest as well as principal on the debt instrument. The redemption is as per offer document. Redemption means at the time of maturity or at the end of time period of the debt instrument, convertible debt, the principal has to be repaid to the investor and it should be in alignment with the offer document. Now, for qualified institutions, that means which fall under the private placement category, the regulations specify that there should be a specific special resolution by the shareholders in such regards. The equities which has to be offered to the qualified institution should be listed in a recognized stock exchange. And one of the most important thing is the promoters of the issuer are not fugitive economic offender. That means duping general public from their money, their invested in the organization. Now, general obligations that is part of regulation, prohibition on payment of incentives. The issuer or the merchant banker of the issuer shall make no incentive payment to the potential investors so as to attract them towards the particular issue. The public communications, advertisements, and research reports before the issue starts should be true and non distorted. You cannot give any kind of false information. After the issue is over, the reports are prepared and they should be submitted by the merchant banker to the board of directors. The content of documents are not to be manipulated. And the merchant banker should redress the investor grievances. That means a minimum of 95% of grievances should be redressed by the merchant banker. A compliance officer should be appointed to take care of all the activities. And finally, the merchant banker should provide that all the activities is fair and as per the regulation laid down by SEBI, that is due diligence certificate. Now with this, we'll be ending the today's session. Thank you.